I better check my hair too. Well, welcome everyone. This is the next in our series of regular monthly educational webinars that we hold for clients and people who are interested to learn more about investments and finance and so forth. Today's presentation is on the 6 things everyone knows or everyone needs to know about the markets. Now, with that being said, there are actually a lot more than 6 things, but we tried to find 6 items that we thought were relevant and present them in a way that hopefully many of you listening are going to go, I didn't realize that. I wasn't aware of that. Now, what I find, I've been in this business 30 years, and many of you who are listening in on us know that we did radio for 20 years locally here in Toronto. And during that time, literally thousands of people came to my office looking for help. And I found there's really 2 main types of people, the way I look at it. One, there's people who come and listen to something like this in a webinar, and they feel everything is great. They feel my finances are well in towed. I just want some more information. And that's great. If you're one of those people, great. I'm glad you joined in. Hope you enjoy it. Hope you learn a few things. Then there's another set of people who kind of know that things aren't quite right. Maybe they have an idea what's not right. Maybe they don't, but they know things and they know they should be doing something. So they're listening to a webinar like this, trying to say, well, what should I be doing? What's the next step? Many of those will listen to this and get hopefully a lot of good ideas, but won't do anything. So this is your opportunity here. What happens sometimes, I think people make mistakes. Have you ever tried to get more and more information about things? And sometimes sometimes people wait for the perfect moment, the perfect strategy, the perfect time in the market. And that perfect time, that perfect strategy doesn't exist. So at the end of the presentation, we're gonna have some fun, by the way. I'm gonna have a short quiz. It's 4 questions, and hopefully that'll help everyone understand, everyone who's listening, get a better idea is, are they in great shape or do they need some help? Now, just a bit of an introduction to us here. Those of you who know us, some of you may not, West End Wealth Planning. We do things a little bit differently here. We believe in a very big picture. We don't focus on one thing. We believe that your financial health is the sum of many issues. It's not just your investments. It's your risk management. It's your estate planning. It's your tax issues. Is everything all together for you? And we tend to work best. We deal with a number of business owners and successful people and people who are serious and appreciate the value of planning. People who are looking to achieve what we call a work optional lifestyle. Or if you're nearing or in retirement, they want to not worry about money and they want to build a lasting legacy. So we tend to work best with those people. And what we've done is develop a strategy that helps people put all of their financial puzzle in one place. So they always know where they are and where they're going. And we call that the guidepost formula. Now, today, I'm very pleased to have, to join me is my associate advisor and son, William Barreca. And William, by the way, is a student of money. I believe, Will, you have read every one of Warren Buffett's annual reports. Is that right, or virtually all of them?
That's right, all of them, dating back to the 60s.
So he's way above me. I've read a few of them, but I can't read them all. So I'm very happy to have William here. Again, he's a student of money, and we're going to have a bit of almost like a fireside chat, asking questions. And by the way, we want you to ask questions. If you go to the bottom of your screen, there's a place called Q&A. You can go in there at any time during the presentation, even right now, and say, Paul, I got a question, whatever it is, feel free to ask at any time. We will try our best to get to it during the presentation. Can't guarantee it, but we'll do our very best. We're also going to try and be respectful of your time. We're going to be out of here no later than 1 o'clock. Keep this strictly to an hour. We'll probably talk 45, 50 minutes. We'll leave a bit of time for Q&A at the end. But again, feel free, ask questions, go to that Q&A. Do not go to the chat box, please. Go to the Q&A and ask whatever questions that you want. Today's presentation also, I believe, will be available on our website, westendwealth.com. I don't know how long that takes, Will, several days probably. And we're going to go through our 6 topics today. We're going to discuss them briefly. But before we do it, I want to really emphasize that a lot of the things we talk about today, it's not a cookie cutter, one size fits all. Some of these strategies might make sense for some people, some may not make sense for others. That's why this is a very, very personal business. Everyone is different. I always tell people who come to my office, I can have 10 people in front of me who are around the same age and have the exact same financial situation, but each one of them will deal with money differently. They have different attitudes, different ways they were brought up with money, and that's why their plan for money, for their investments and so forth is different. So, well, why don't we get going with the presentation today? And you're going to pepper me with a couple of questions. Why don't we get going?
Sure. So let's start off with politics, especially since we're coming off an election year. Paul, I know both of us often hear, whether it's from the media or people we speak to, the effect that whoever's in office is going to have on the markets. Before Trump was elected, people thought he would bring turmoil to the markets and they would crash when he was elected. And people said similar things before Biden was elected. So what, if any, effect do you think the president has on the stock market?
Well, that's a great question. And of course, we always see this in the media. We hear things like, oh, it's going to be a Republican. And I'm talking US because let's face it, the US has a lot more effect on economics than Canada does. Oh, the Democrats are in the office, that's bad or that's good. The Republicans are in the office, that's bad or that's good. And I think I've seen stories that support both sides. But if you look, and that's true, what you said before Trump, I remember that very, very clearly. Everyone said, or everything that I heard in the media was suggesting that if Trump gets elected back in 2016, market's going to go in turmoil. And I remember immediately after he was determined to win, the futures market went down for, I think, 7 or 8 hours. And then they started to go up. And they've essentially been going up for the last 4 years, take aside the pandemic. So really, I'm going to try to put up something on the screen here. And hopefully I'm not going to make a mess of this, but let's see what we can do here. Now I'm going to share screen. Here we go. This shows us, this goes back and looks at every single president, starting from Hubert Hoover to Donald Trump. And it looks where you can see that during every single presidency, there was a situation where there was a large drawdown. So I see this represents, oh, can I read? Should I do this here? There we go. There we go. This represents under each presidency the worst drawdown or the worst drop in the stock market. So you can see during every single presidency, there was a significant drop in the market. So in my opinion, I don't really think there's a lot that makes, there's a big difference in who's in the White House. Now, of course, that doesn't necessarily mean that some of the tax policies and so forth of the individual presidents may not have a short-term relevance, but in the big picture, I don't think it makes any difference. And I don't think anyone should be basing their investment strategy, their financial planning strategy, their wealth strategy based on who's in the White House. Doesn't make any sense at all as far as I'm concerned.
The big thing that stuck out to me for the Trump presidency anyways, was that if you expected anything to do well while he was elected, you would have thought it was energy stocks because he was very pro-energy, pro-US energy. And they
very true, yeah.
They did very poorly while he was in office. So that just shows, again, another example of maybe giving too much credence to the effect that a president has on the markets.
Well, that's true. And here's the thing, people, we're going to talk about this a bit later in the presentation. People look at history and they go, oh, history is a good way to predict the future. But if you think about it, history is merely, for the most part, a study of surprises, a study of things that no one knew would happen. So to go back, it doesn't jive. If you're basing your predictions about what's going to happen in the future on history, And history, for the most part, is a series of surprises. It doesn't make sense.
That makes sense. To move on, I guess. So I was wondering also, another thing we often hear, Paul, from clients or other people we speak to is that they kind of try to predict what's going to happen in the future based upon what happened in the past. So I was wondering if you could talk about that. Is it an accurate way to look at markets where whatever happened in the future is reasonably, you can reasonably expect that to continue in the future?
Well, that's kind of, we're going to kind of piggyback onto what we're just talking about. And well, let's look at this thing. Let's talk about portfolio planning. 25 years ago, let's say a model balanced portfolio would be 60% equities and 40% fixed income or bonds. Well, 25 years ago, a bond, you could buy a government bond that would pay 6 to 8% annual interest every year. Well, now, if that was 40% of your portfolio, you could count on 40% of your portfolio yielding 6 to 8%. Today, those same bond yields are maybe 0.5% or 1%. So if you have the same portfolio that you had 20 years ago or 25 years ago, 60% in equities and 40% not in equities, everything else being equal, you're going to get a substantially lower long-term rate of return. That's why if you look today, and that would have been another good visual that I perhaps should have brought up, how portfolios have changed. Today, there's much more. You can't just put in your 40% or 35% bond weighting. You can't just put in government bonds. You need to put in alternative assets, private debt, high yielding. There's a number of new strategies that you have to be creative with. And my guess is that 5 or 10 years from now, those will change. There'll be new strategies that come into play that make sense, things that maybe we haven't thought of now. I mean, let's look at this. Here's another way to look at it. 10, 12 years ago, Will, who was the darling? Or let's ask this to the people who are, the people that are listening in. Who was the darling of the tech world 10, 12 years ago? Does anyone know? And by the way, if you want to go to the chat line and just answer the question, you're welcome to. Well, the answer everyone knows, but many have forgotten, was BlackBerry. BlackBerry 10, 12 years ago, that would be 2009, they were the kings of the smartphone market. The iPhone had just come out, didn't have a huge market share. The BlackBerries were it. Do you remember when Obama took office? He didn't want to give up his BlackBerry.
Yeah.
Well, now look where they are. They're zero market share, basically. Although I still have a couple of friends who insist on using their BlackBerry. So again, as I mentioned before, history is really a study of surprises. I mean, you could look 9/11. No one predicted 9/11. The financial crisis in 2008. No one predicted that. Matter of fact, I believe Ben Bernanke in January of 2008, the head of the Federal Reserve, said, it's going to be a good year. Everything should be fine. The 30 odd top economists met with then President Bush in March of 2008, 6 months before the financial crisis. They said unanimously, it should be an okay year. Who saw the fall of communism? Who saw Google coming? Who saw Facebook, et cetera, et cetera? And you know what? 5 years from now, there's going to be things happening, companies or nuances that we can't even imagine right now. They're going to be there because things change so quickly. So again, I mentioned this in the past. If you're basing what you think is going to happen in the future based on history, and history is full of surprises, well, isn't that kind of ironic? Do you see a problem in that? Does that make sense? So by the way, someone checked in there and mentioned who was the darling with Nortel. Again, a little bit back, a little bit farther, more 20 years ago, but the same thing. Nortel was the king. And well, we know what happened to Nortel. So again, here's, new strategies will come along, and you just want to be careful of things like lower volatility, alternatives, and so forth. The secret of this is in your planning, you want to always review and update things. This is key. That's much more important than looking at history and saying this stock did well, or this pool did well, or this ETF did well in the past, because it may or may not do well in the future.
Yeah, things are definitely changing at way quicker pace than they used to. Even if you want to go outside of tech stocks, a company like ExxonMobil, which for decades was consistently in the top three or
Yes,
five most
yes.
valuable US companies. And last year, I believe it got knocked out of the Dow Jones index even.
Yeah, things changed. And back in the late 60s and early 70s, there was something called the Nifty 50. These were the top blue chip companies of the time that people said back then, put your money in these, they'll never go down. Well, those included companies like Polaroid. And they went bankrupt 10, 15 years ago. Kodak, again, bankrupt. Now they're both back under after post bankruptcy. But this is what happened. What you think is, and that actually that's good because that talks about something else. We all believe psychologically, this is ingrained in us, that whatever trend is happening now, whether up or down, will continue into the future. And that is absolutely not true.
So next, Paul, I was wondering if you want to talk about when people feel that they do or don't need help managing their money. I know we've talked to a lot of people who say things like, oh, I watch the news, I read the news, I read all sorts of things online, so I can kind of handle my portfolio myself. What would you say to someone who feels that way?
Well, that's a great analogy. We do hear that. I've had people come into my office and say that exact thing. Says, "Well, I keep up. I watch, CNN, and I watch NBCN, and I watch this, and I keep up to date on things. So I think I'm pretty okay." Or really a great one was, "My son has a finance degree, so I think we're just fine." But I guess the best way to talk about that was to talk about a company called Dalbar. What is Dalbar? Dalbar is a rating service out of Boston. That's all they do is look at rating and behavior of people in the investment market. They don't sell investment products. They don't sell mutual funds or ETFs or anything like that. All they do is study behavior of people who own investments. And they do an annual report every year. They've been doing this for decades. And what they look at is they compare how did certain, let's say, how did the stock market do last year? And how did the average investor do? And the way they do that is they look at mutual funds. They'll take a mutual fund and say, on average, the mutual fund itself earned X amount last year. Let's just say it earned 8%. I'm just picking numbers out of a hat. Every single year, there's no, it never changes. The average investor who invests in the exact same fund earns 2 to 3% less. It doesn't vary much year to year. So why does that happen? How could that possibly happen? If you own ABC fund and it earns 8%, why don't you earn 8%? Now, I've asked that to people in the past. What kind of answers do you think we got on that, William? Any idea?
No idea, Paul.
Okay. And they say, well, it's because of fees. I go, no, this is all after all the fees. Nothing to do with fees. There's only one reason why people earn less than what the investments they invest in. And that is they buy and sell at the exact wrong time. So if that fund or pool did 8%, they probably bought it partway during the year when it was on an uptick. Because emotionally, we're all kind of the same. We're all succumb to fear and greed, all of us, me included. So it's buying and selling at the wrong time. You see, it's not uncommon where people talk about, getting more information. I need more information. I got to do better, more spreadsheets, more analysis. But really, the study doing well in finance is not about spreadsheets. It's not about analysis. And this has been proven time and time again. The study of finance is the study of human behavior, how we all react to things. And another analogy you could say, there's some really, really smart people who don't do well at finance. I've met actually doctors and lawyers in our industry, extremely smart people. I could never do what they do, not even close. But a great majority of them don't do well with financing. They're really smart. That surgeon is so smart at in the operating room. But because you're smart at one thing doesn't mean you have good attributes in another. And we see this all the time. Matter of fact, here's a worst case scenario. By the way, I have people coming in here going into the chat line, and it's better if you go to Q&A and you have a question, please go to the Q&A. Again, we're open to any questions that you have. Please go to the Q&A box at the bottom. We'll do our best to answer them. Where was I, William? I was talking about, here's an actual story. It was a sad story. It was quite some time ago. I met a doctor who came to my office looking for help. He was 65 years old, made a good income, $200,000-$300,000 a year plus whatever it was, it doesn't matter. This doctor had a net worth of zero, nothing. He owned a home, but because he got he tried to get so aggressive with his portfolio and had so much debt, he had a net worth of zero. He said, Paul, what can I do? And I said, I can't help you. I felt very bad after that meeting. So again, it's not necessarily being super smart or having a huge IQ. Buffett has said this many times, right?
Yeah, I was going to say this discussion reminds me of something Buffett said at one point, where he said the most important investing attribute isn't intelligence, but it's temperament instead. So it's not about how smart you are, like you said, how many spreadsheets you can come up with or anything like that. It's really just having the proper temperament and the patience to withstand the normal volatility in the stock market.
Let's look at it this way. Let's ask the people who are listening today. Now, you may say, you might sit down with your advisor and say, okay, I can withstand a 20 or 30% drop because I understand that's normal. But when it actually happens, when you see your statement drop a significant amount of money, you can become physically and mentally exhausted. And the exact time when you need to have confidence in your strategy, that's the exact time when you may lose it and make a bad decision. You see, spreadsheets are great at showing what goes up and what goes down, but they're not good at telling you how you're going to feel at night when you sit down and you think about the financial decisions that you've made and how they may affect the long-term situation for your children. You see, what we are able to handle technically, or what we're able to endure technically, is often very different than what we can endure emotionally. Very different. Because we're all, by the way, one of the things I should probably almost do a presentation on this. We are all susceptible to our own human biases. We're all guilty. Every single person on earth is guilty, some more than others. And one of the worst is confirmation bias. This is one of the biases that we all succumb to. For example, let's say I'm asking our listeners out there. Most people are either politically, say, a little left wing or a little right wing, and it doesn't matter which way you are. But let's say you're a little left wing. When you read political material on the media or anywhere, do you tend to read more about things that support your point of view, or read more about what do not support your point of view? What do you think? Well, you know the answer.
Yeah, of course the answer is that people like to listen and read things that they agree with already.
Yeah, and that further makes their ideas concrete in their mind. They further believe what they already believe in. It emphasizes that. The same is same with anything. Whether let's say climate change, whether you agree with it or don't agree with it, you're going to read things that support your point of view. Whether you believe we have a flat Earth or not, if you believe there's a flat Earth, you're going to find things that support your point of view. Whether you're an anti-vaxxer, it doesn't matter. We're all the same, and this revolves right around our investments. too. For example, some people believe the market is fixed. You can't make money in the market. It's all fixed. You'll find information to confirm what you feel. These are the things you want to be careful of to try to avoid that confirmation bias. And if you believe in one particular belief, you got to be open to looking at other beliefs. So, by the way, this is known as, yeah, Will, you had
Sorry, I was
something?
just going to say we've had a couple questions come in I thought might be good to tackle.
Oh, great, thanks.
They're kind of interrelated, so I'll read out both of them and get your thoughts on them. The first is the markets in the US have been on a tear. What is your prediction for the rest of the year? And next, another question is you can't time the market, but should we perhaps reduce exposure to equities now?
Well, good questions. And they've been come up, our clients are asking the same questions. And again, well, why don't I share a screen and I'll give my, let's see now.
And that also ties in, actually, sorry to interrupt. We had a third question just come in. Again, it's somewhat interrelated. Has things start to open up in 2022 and with the pent up demand, will we see larger percentage returns for a few years?
Well, again, good question. Again, we can look back about the U.S. exposure. We've been overweighting U.S. for, well, a number of years. It's worked out well. Not a huge overweighting, because I don't really believe in making bets on one asset allocation or geographic location or another. The thing is, we really don't know. Again, we can look back and say, well, the U.S. has done really, really well for such a long time. Maybe it's time to diversify. Well, I'm suggesting that you should be diversified already. That anytime you start putting more of your eggs in one basket, you're taking more risk than perhaps you should be taking. What were the other questions there, Will? I'm sorry. Let me take a look here.
So there was one. The markets in the US have been on a tear. What is your prediction for the rest of the year?
I don't have a prediction. I don't know what's going to happen. And to me, anyone who tells you they know what's going to happen is just guessing. And I don't guess with clients' money. I have no idea what's going to happen. And that's not what people like to hear, by the way, because we all like to hear what people think is going to happen. We like to have that confirmation but the fact is we don't know what's going to happen. I mean, 13 months ago, who would have predicted the pandemic? No one. Any one of the crises that have happened, no one predicted them. I certainly can't predict what might happen later in this year. However, it is a good point. We're looking at massive, massive amounts of savings in the States. Massive amounts, trillions and trillions of dollars of money that people have on the side. Unemployment rate is down from a high of over 14% last April to now 6% and going down. There's a lot of people saying that because of all this money on the sidelines, that we could see some very good growth over the next year or two. I mean, it's kind of common sense. We don't know for sure, but it kind of makes common sense.
The thing to keep in mind, though, with this always, the caveat is the economy and the stock market, especially in the short term, don't always coordinate with each other, right? You can have a really strong economy and a bad stock market and vice versa as well.
Great point, Will. Great point, Will. This often happens. Matter of fact, you could say that the perfect analogy is last March. March 23rd last year, the markets hit the low. The U.S. markets dropped 35% in 33 days, the quickest drop into a bear market ever. Anyone on March 23rd last year, I bet almost everyone in the world was thinking it's going to get worse. It didn't. It started to get better, and it's been getting better almost continuously since that time. You're absolutely right. You never know what's going to happen. However, it makes some sense that this will certainly support the huge amounts of cash on the sidelines. Plus, all governments are saying they're going to keep those taps open, in terms of spending taps open for certainly the short and medium term. So we'll see what happens. We'll get back together again in a year and see what happens. One other thing here. Do we have another question? I think we've dealt with most of the questions for now. Oh, we had one on cryptocurrencies. Just quickly, I look at cryptocurrencies as more of a speculation. I don't own any myself. I'm not saying anything for or against them, but it's still a great unknown for a lot of people. So it's if you want to put some cryptocurrencies in your portfolio for a small amount, fine, maybe 5% tops, but I certainly wouldn't put the bank on it because you could be in for a rude surprise. I mean, cryptocurrencies in what was it, 2017 went up to 10,000 and promptly dropped to about 1,800, about an 83% drop in something like about a year. You don't want to put your portfolio on something that could potentially do that.
Yeah, makes sense. Next, Paul, I was wondering,
by the way, just excuse me, Will, just want to mention again, more questions. We love the questions coming in. Keep them coming in. Just go to the Q&A box at the bottom of the screen, please, and type in. We'll do our best to get to them, okay? Great, Will. Sorry.
So what, Paul, do you think is the most important part of investment success? Would you say that it's maximizing your returns?
Well, boy, that's a great question. I speak to people all the time. And they say, Paul, I want to maximize. I want to get the maximum return out of my money. How can I get the best return? And well, let's talk about that. If you owned a sports team, a professional sports team, baseball, hockey, doesn't matter. What type of team is going to win you a championship? Now, if you own a baseball team, you own the Blue Jays, I'd ask our audience out there, if we stack that team with home run hitters, but our pitching didn't cut it and the defense wasn't good, do you think there's any chance you're going to win the World Series? You're going to have a lot of fun catching, baseballs out in the outfield, but you're probably going to lose a lot of games. Same analogy with hockey. You got a great forward lines. You can score goals like they're going on a style, but your goalie's a sieve and your defense is weak. You're not going to win the Stanley Cup. The same thing relates to investing. And an easy way to do this is a quick mathematical formula. If you have $10,000 invested and you invest aggressively and your investment drops 50%, so your $10,000 has now gone to $5,000. What percentage return do you need to get back to the $10,000? Now, a lot of people say, well, 50%, but that's wrong. Remember, if you're at 10,000, you lost 50%, you went to 5,000. What percentage return do you need to get from 5,000 to 10? You need 100%. You need double. So that's why, and Buffett knew this too. By the way, it's a great story. How many people know that, many people don't know, Warren Buffett has a partner, of course, Charlie Munger, and they've been partners for, I don't know, a million years. But many don't know that they had a third partner, a fellow named Rick Guerin. Am I pronouncing that right, Will? Guerin?
Guerin, yeah.
Guerin, sorry. And they had a third partner, Rick Guerin, in the 1960s and early 70s. And Buffett, reminiscing about Rick, and they still stay in contact, he said, Rick was as smart as Charlie or I. He knew everything that we knew. But Charlie and I were patient. We knew we'd be very wealthy. We had no doubt whatsoever. We were patient. Rick wasn't patient. Instead, in the early 70s, he loaded up on aggressive investments, leveraged. And markets dropped in the early 70s, and he had what they call a margin call. In other words, he had to sell his investments to cover his loans. The bank made him do it, and he had to sell back his Berkshire Hathaway shares to Warren Buffett. And he sold, excuse me, he sold his Berkshire Hathaway shares back to Warren Buffett for less than $40 a share. Now, what are they selling at now, the A shares, Will?
As of yesterday, they're a little above $402,000. So
the shares that Rick got into trouble because he was too aggressive, had to sell his shares under $40 that would be worth over $400,000 a share today. And that, I can't think of a better analogy. People get caught up in this market today. I mean, I saw some statistics this morning and yesterday. There's an index in the US called the Wilshire 500. And since March 23rd of last year, 95% of the stocks in this have made money. 95%. I mean, you could have monkeys throwing darts at a board, picking stocks. They'd make money. So many of us know that a discount online brokerage in the States called Robinhood has attracted huge numbers of new people setting up their own accounts, doing day trading. You know what? And a lot of these people have probably made some good money. And it's pretty easy to make good money when most things are going up in value. Monkeys, and they've proven this, monkeys could throw darts at a stock board and make money. But what's going to happen when that doesn't happen? And we will have our normal volatility. So again, the most important thing really is having a balance, like a sports team. The best baseball team, the best hockey team, there's a good solid offense and a good solid defense. Those are the teams that win. And remember, the goal at the end of the day is to be retired at a good income and not worried about money. I heard another good analogy about this. Someone asked how many players in the Master had gotten a hole-in-one, and I think the answer was 11 or 12 to date. 11 or 12 hole-in-ones, golfers in the Masters. How many of those golfers that got holes in one actually won the tournament? None. Again, who was it? Jack Nicklaus said, you drive for show and putt for dough. Do your putting well. If you're a baseball team, you want to get to base a lot. You don't want to worry about the home runs.
All right. Well said. Let's move on here quickly because we do have a few more questions that we should get to at the end.
Great.
We're seeing now markets hitting all-time highs again after a little bit of volatility in February. Should investors be concerned now, especially if they're looking to deploy new money?
Well, that's a natural question. Any investor would be asking that. But here's something that many people may not know. Between 2013 and earlier this year, 2021, and I'm using US numbers, the S&P 500, the US index of the 500 largest stocks, hit a new high 281 times. You didn't mishear me. In the last 8 years, the US market has hit a new high 281 times. Now, at some point, obviously things are going to go down. And by the way, during that same time period, there were 16 times when the market dropped at least 5% or more. So, by the way, I think you got the number. Well, during the same time period, what was the increase on the S&P 500? I think you have that number.
Yeah, it was just over 153%.
153% increase. So here's something else. I'm going to show our listeners here. I'm going to screen share, and hopefully this will work. Hopefully this will work. That's not that. Oops. Sorry, guys. Move that up there. Oops. Come on, come on. Come on.
The one to your right there that says XPX.
Fortunately, I have this on the top here. I apologize, everyone. I'm just trying to show this. There's this bar at the front. Stop, and I can't get rid of it. There we go. There we go. Let's try and make this a little bit bigger. So this represents the stock market from around April of 2012 to 2019. So a little bit out of date, but it doesn't really matter. So this represents all of the doom and gloom forecasters. So here we're starting in 2012. Bill Gross, which is the managed the biggest bond fund in the world. The cult of equity may be dying. The cult of inflation may have only just begun. Here's another one. Prepare for a massive market meltdown. By the way, this is in 2012. Harry Dent, well-known author, sees a crash in the third quarter of 2013 for a year and a half. Go up and down the line. Here's another one. Sell everything and brace for a cataclysmic year. That was in 2016. That one didn't quite happen. The crash of 2016 is coming. That one didn't happen. Let's see. Oh, this gentleman predicts 50% unemployment and a 90% stock market crash. That was around 2015. That quite didn't work out either. I think you get my point. We can go at any time. And oops, how do I get back in here now? Stop sharing. There we go. There's always doom and gloom in the market, and prices are high right now. They are considered pricey. But again, the same thing happened. If you recall back in 2009, 2010, 2011, many people were saying they're worried about inflation, all this new money that came in after the financial crisis. That didn't happen. Now the same warnings are going out today about inflation, and I don't know what's going to happen because the world is different today. The governments work differently today. They actually know more and they're doing a better job, but I don't know what's going to happen. And a lot of people are saying things like this. They're just guessing. And they're just trying to make headlines, if you ask me. I don't think they're doing people a lot of justice by creating all that doom and gloom. What about all the people that would have reacted to those headlines and sold everything 5, 6, 7, 8 years ago and lost maybe 50% growth on their portfolio or more? What position would they be in? The thing is, you can't time the market. No one has been able to figure out how to do it properly. There's always a few exceptions that you read about, that this person accurately predicted this. But what they often don't say is the other 19 predictions the same person made that didn't work out that well. So you can't predict what's going to happen. I don't know what's going to happen. The secret is to have a balanced portfolio, to have your portfolio in line with your risk tolerance, understand what your maximum downside is, and perhaps most important, you have to have a goal. What's your goal? What do you need to earn on that portfolio on average over, say, 10 years to get you to your retirement goal? So
I guess lastly, Paul, to expand on that, what would you say to investors who are concerned about volatility in the markets right now? Obviously, it seems like things lately are more volatile than ever. What do you say to that?
yeah. By the way, just reminding everyone again, go to the Q&A box at the bottom. We're going to have some time to take some questions probably at the end. So don't hesitate. Go there. We love your questions. Well, great questions. That's interesting. And it's not uncommon where people come into our office or we talk to people and they say things like, Paul, I don't know whether I want to do anything right now. The market's volatile. I'm going to wait. My question is, what are you waiting for? What are you waiting for? Markets are always volatile. They always have been volatile. And I'm guessing they are always going to be volatile. If they were not volatile, you would not earn the 8 to 10 to 11% annualized returns that markets have provided going back to the 20s. Because everyone would put their money there, there'd be less risk. Waiting for that perfect time doesn't work. There's no magical moment. This is an analogy I like. People always say, I want to wait. I want to wait till markets go down and I'm going to buy at the downside. I'm going to buy at that low point. Now, quite honestly, very few people actually do that, because when the market has gone down, the media is screaming doom and gloom. Now, if the media is screaming doom and gloom, most people don't want to put their money in the markets. It's almost like people are waiting for someone to tap them on the shoulder and say, now's the time, do it right now. No one is going to tap you on the shoulder. Say,
the thing that spooks people a lot is reading things in the media, because there's always something in the newspaper or on the news that you can interpret as a negative for stock market returns going forward. If you open up any newspaper going back decades, there would be something in there that would make you hesitant to invest in the stock market, yet it keeps going up and up every year.
Of course, the media has to fill up the media. and bad news sells, good news doesn't. I mean, I think if we opened up a news site and it said, headline was, everything's going pretty good today, don't do anything, I don't think that's going to create a lot of attention and a lot of readers. So, and there's a whole psychology behind headlines, and I've done some studying, and that's very fascinating to get you to read things. I love reading the media where I do all these news sites, and they'll say things like, the 4 stocks that are going to double next year. Really? How do you know this? They're quite comical. You see, the volatility is the price of admission. And like anything worthwhile, successful investing demands a price, just like anything. And it's not in dollars and cents. It's in volatility, it's in fear, it's in doubt and regret. And they're all easy to overlook if they're not happening. But when they happen in real time, when the stuff hits the fan, that stuff that you thought you could overlook makes it really challenging to overlook. So again, it's normal. There's always, you mentioned, there's always an expert. And by the way, again, just looking at a bit of statistics, I'm reading from my side here. Since March of 2009, there have been 28 corrections. This is just over around about 12 years. There have been 28 corrections of 5% or more in the market. That's normal. It's going to continue to happen. It's not going to stop. I think we got a few questions. Here's one. And by the way, you can ask your questions anonymously if you like. No questions. For some reason, residential real estate prices keep going up. What about commercial real estate? Well, again, I'm not an expert on commercial real estate. I understand, excuse me, that I'm talking about the Toronto area, Southern Ontario, because of warehousing needs, companies like Amazon, there's good pressure right now and prices are going up for industrial commercial real estate. How long that lasts, I don't know. Again, when we go into a post-COVID world and you can go back to the shopping mall, undoubtedly things have changed. People's, how they deal with things, their habits will change, but certain things will go back to the way they were before. We're already seeing, if you in downtown Toronto, there was a big price decline in rental rates last year because everyone wanted to leave the city. But I'm reading now, prices are starting to edge up again. People are starting to go back. My guess is a lot of the people who left the city to go to some small town to live, at some point in time, a good portion of them, or a portion, maybe a good portion, are going to go, there's nothing to do here. I don't like it here. I'm going to move back to the city. That's my guess anyway. So another question here about interest rates. Do you foresee interest rates are historically low? Do you foresee interest rates for bonds, GICs moving up to 7 or 8%? I'd say that's unlikely, but who knows? Again, anything could surprise us moving in the future. The economy today is very different than it was 20, 30 years ago, but anything could happen. I don't really have a thought on it. I think it's likely that interest rates will go up in the short to medium term, maybe 1 or 2%. I don't know. I don't know. Secret is, again, plan for this in your portfolio. You don't want to have long-term bonds in your portfolio because they're not going to do very good in a rising interest rate environment. So again, what other questions do we have here, William? Maybe we'll go on to another, actually, here's another idea. We want to talk about inflation. Oh, there's another question down here. Oops, can I get down? How do I do this here? Oh, thank you very much. Someone just says we rock. Thank you very much. We try. Another thing that people often underestimate is inflation, isn't it, Will?
Yeah, that often comes up when we're running our retirement income plans for our clients. And it's not an uncommon thing we hear where someone gets either at retirement age or approaching retirement. And they say, okay, Paul, William, Akiva, I'm done. I'm retiring now. I just want to live off what I have already. I don't want any more volatility. I'm retired. I have no more money coming in. I can't withstand it anymore. What do we tell those people when we have those conversations, Paul?
Well, that's it. A common thing is keep my capital. Keep my capital even. I don't want to lose my capital. So if someone has $1 million today and they retire at 65, they want to have $1 million at 85. But what they often don't realize is they don't have, even if they have $1 million, they don't have $1 million. Because at 3% inflation, that $1 million loses half of its purchasing power in 24 years. So if you're 65 and you're not, well, say around late 80s, and you still have $1 million, you have the purchasing power of $500,000. And people don't realize this because it creeps up slowly. And things that happen slowly, you don't realize. Things that happen quickly, you realize. But little things that happen slowly, you don't realize. So that's something you always want to factor in to your retirement planning. We're getting close to the end. I promised people a little quiz to determine what kind of shape they're in financially. I have 4 questions, and I want to maybe get to them now. By the way, I want to mention our next educational webinar is on, I believe, May 12th. Is that right, Will? At 1 p.m. I believe that's a Wednesday, and it's geared towards a business owner. It's called Finding Your Business Blind Spots That Can Sabotage Your Business and Ruin Your Retirement. Now, if you're a business owner and you really don't want to miss this, and if you'd like to get information on that, just go to our site and go to info@westendwealth.com.
Send us an email.
Send us an email. info@westendwealth.com. But here's some questions here to help you determine if you're in good shape financially. Do you know how much income you will need in retirement on an after-tax basis? Do you know that number or roughly that number? Here's another question. Do you know what you need to have in your retirement nest egg that can provide you that income? Do you know that number? Next question. Do you need to know what needs to happen to get there? 3 questions. 4th one. Do you have a risk management strategy so you can attain your goals when the inevitable critical financial events happen during your life? In other words, well, how do you protect the downside? Now, if you're answering affirmative to all those 3 questions or all those 4 questions, you're in probably pretty good shape. But if you're answering negative or unsure, you might want to look and rethink about where you're going. You know, it's interesting. Well, people spend often huge amounts of time planning holidays. They'll spend, if they're going to build a home, they'll spend huge amounts of time, years on planning. But oftentimes they spend very little or no time planning their entire financial life ahead of them. How they're going to live in their retirement years, which in many cases is as long as their years that they're working nowadays, as we're living longer. So again, have the plan. That's really, really key. By the way, I mentioned also at the beginning, there's a couple types of people who tend to watch these types of webinars. You know, the people who are just listening for the information. That's great. Glad you joined us. And then there's the people who know they need to do something. For those people, you have an opportunity to act. If you're interested, give us a call. Send us a text. Not a text, I'm sorry, send us an email at info@westendwealth.com. Say, hey, I'd like to chat with you guys. Because again, what you want to avoid, and this we've seen this many, many times. How many times have people come in our office, Will, and said something like, boy, I should have done this 10 years ago. Why didn't I get going 10 years ago? And of course, we know what the answer is, right? We're all natural procrastinators, all of us to varying degrees. And we put off because we're all busy today. We're all busy with jobs and work and businesses and kids and all this stuff. And it's really easy to put off what's way down the road until it stares you at the face. And then you go, holy crap, why didn't I look at this? And it makes it harder, that's all. So again, I urge you all, give us a call or send us an email at info@westendwealth.com. We're happy to sit down and have a chat with you. It'll make your life much, much easier. Got another question here. I think we can pop another one in here. What's our opinion on reverse mortgages? Reverse mortgages are a way to draw money out of your house on a tax-free basis to supplement retirement income. It's like any strategy, it can work for certain people, but other people aren't interested. Other people don't want to take on a debt during retirement. The problem with a reverse mortgage is you never have to pay it off while you're alive. But what if you need to move before you drop dead? Now all of a sudden you have to pay off the bills. And that can be a very big nugget. We've talked to a few clients about this, and it didn't really resonate with many of them. And so that's my opinion on second mortgages. So I think it's time to pretty well wrap this up, except I want to add one more little save screen. I'm going to show something here, share a screen. Does anyone recognize this guy? Does anyone watch
Shark Tank?
What is it? Shark Tank. Daymond John, one of the sharks in the US version. And the quote, I think, is absolutely perfect. Don't wait for the perfect time. You will wait forever. Take advantage of the time that you're given. You know, one of the things I heard the other day is the one thing we have in life is time. And we can't get any more of it. We can't get any more of time. How do I get back on here? Leave. There we go. Leave. There we go. Jeff Bezos has the same 24 hours every day that you and I have. You can't buy any more time. People spend so many time waiting for the perfect strategy, the perfect time to invest in the markets. In the meantime, time flies by. Don't wait. If you need to do something, act now. And that's it. Again, our next presentation in our educational series is on Wednesday, May the 14th, right, Will?
May the 12th.
And May the 12th, I'm sorry, May the 12th at 1 p.m., geared towards the business owners. How to find your business blind spots that can sabotage your business and ruin your retirement. If you are a business owner, you do not want to miss this presentation. Great, listen, I want to thank everyone for joining us today. Thank you so much. I hope you all enjoyed it. If you have any questions, this will be on our website in several days at westendwealth.com if you want to watch it again, or if you want to ask us something personally. Again, just pop an email in at info@westendwealth.com. We promised to get everyone out before 1 o'clock, and we're sticking to our words. So again, I'm going to say goodbye to everyone. William, last words?
Thanks, everyone. Thanks for joining us.
Okay. Have a super day. Stay safe, and hopefully we'll speak to you soon. Bye-bye now.